Hello and welcome back. Today I'll be doing this particular question called Vogel. Alright, so let's just see the requirement. We are still doing mergers and acquisitions. So requirement 1 is what? Discuss the possible reasons why Vogel company may have switched its strategy to organic growth to one growing by acquiring companies, right? Why would the company have switched to organic growth by acquiring companies, right, rather than organic growth? From organic growth to acquiring companies, right? 4 marks. Number B is possible actions. So possible reasons. Discuss possible actions a Vogel company could take to reduce the risk that the acquisition of Tory fails to increase shareholders value, right? So that's for 7 marks. Okay, so we could have talk about all those cheap purchase and all, right? And then we could also talk about a lot of things can be talked about, basically not paying too much and all as well, right? All these things we can talk about. Estimate, so that's number. So a relevant calculation that the maximum premium Vogel company could pay to acquire Tory company, explaining the approach taken. Okay, explain the approach taken. So it's always a good idea to put this thing when doing mergers and acquisitions and any assumptions made. Whenever you write an approach, it'll be easy for your own self. Okay, it'll be easy for your own self so that you don't lose the big picture. Okay, it's a lot of numerical thing, right? So first of all, let's focus on the which aspect. Let's see. So Vogel company is a listed company, right? Is a listed engineering company, and it manufactures large-scale plant and machinery for industrial companies. Until 10 years ago, Vogel company pursued a strategy of organic growth. Since then, it has followed an aggressive policy of acquiring smaller engineering companies, which it feels have developed new technologies and methods which could be used in its manufacturing processes. Okay, so it wants to acquire this small companies, right, which could be used to develop new technologies and methods, right? However, it is estimated that only between 30 and 40% of the acquisitions made in the last 10 years have been successfully increased the company's shareholders value. So only 30 and 40%, right? So Vogel company is currently considering acquiring Tory company and unlisted. So Tory, right, which has 3 departments. Department A manufactures machinery for industrial companies, right? So that's the same line of business. Department A. Department B is electrical goods for the retail market, and smaller Department C operates in the construction industry. Okay. So upon acquisition, after acquisition, Department A will become part of Vogel company. Okay, after acquisition, this is all after acquisition. It will become part of Vogel, right? A will become part, and then which will contain its new technologies, which Vogel company is seeking, but B and C will be unbundled. Okay, B and C will be unbundled, right? Unbundling with the assets attached to C sold. Okay, Department C is sold, right? And Department B being spun off into a new company called Negde company. Okay. So that is going to happen, right? So you will be having what? Department A you will be integrating, right? And you will also be getting some cash from Department C, and then you will also be the Department B will also be there. But this thing will be sold out, right? That thing will be sold out. Department C will be sold out. So given is the extracts of financial information for the 2 companies for the year ended 30th April 20x4. Right, we've got the sales revenue, we've got PBDIT, so profit before depreciation and all, right? So we've got interest, depreciation, pre-tax profit, we've got non-current assets, we've got current assets, 7% unsecured bond. Okay, Vogel company does not have it. Okay, only the Tory company has it. So we might have to think about that whenever we are doing our free cash flow method, right? We might have to think about that as well, because we don't want to use that. Other non-current and then current liabilities, share capital, reserves is also given, right? So it's 50 cents per share. So basically this is in millions. Okay, so share of current company and non-current assets of profits of Tory companies departments, right? Okay, so share of what? Current and non-current assets. So these two, the current and non-current assets. Department A is 40%. Share of PBDIT and pre-tax profit is 50% for Department A. That's very huge, huh? Department A constitutes a large chunk of it. And for Department B, it's the same ratio, huh, for current assets and then the PDIT and profit before tax as well. So other information are also given, right? It is estimated that Department C realizable value. We can always write this thing in assumption, right? So we can just say all these values like share of current assets, non-current assets represent the true picture of it, right? We could talk about that. We could talk about the realizable value is of non-current assets is 100% of the book value, but its current assets will only realize 90. Okay, so this current assets times 90%, right? 90%, but for which we are only selling this department, right? So this, so 46.5 times 20% times 90%. Okay, out of that as well we are just getting 90, right, of the book value. And the closing relating to Department C is estimated to be, we need to subtract this as well, right, from the proceeds. Okay, so that's a bit of information. And then the funds raised from disposal of C will be used to pay off Tories and other non-current and current liabilities. Okay, so what is there? Non-current liabilities is there. Where is it? It's not given, right? Okay, there is one over here. You see this one and this one, 20.2, right? To pay off Tories, other non-current. Okay, just this much will be paid off. Okay, the 7% unsecured bond will be taken over by next day company, so not by Tory, I mean not by the combined company. It will be taken by the Department B, which we will basically be making into a new company, right? It can be assumed that the market value of the bond is equal to its book value. Okay, book value and market value is basically same. Okay, then it's easy. At present, around 10% of the Department B's PDIT comes from sales made to Department C. Okay, so we have to subtract that 10% because after C is sold, you won't have that much sales, right? So the sales will have to be reduced. So next day company's cost of capital is 10% for next day company. It's for next day company. So it's I'm not sure if I'm pronouncing that correctly, but still, yeah. It is estimated that in the first year of operation, next day company free cash flow to firm will grow by 20%, and then after that it'll grow by 5.2% annually. So in the first year only, right? So this is basically after that in perpetuity. So tax rate applicable to the company is 20% to all companies. A net gay company can claim 10% TAD on its non-current assets. Okay, 10%. Okay, it can be assumed that the amount of tax allowable depreciation is same as the investment needed to maintain net gay company's operation, right? Okay. So Vogel company's current share is this much, and is estimated that Tory company's PE is 25% higher than Vogel company's PE ratio. We can do that, right? We can do that. That's very easy. After the acquisition, when Department A becomes part of Vogel, it is estimated that Vogel company's PE ratio will increase by this much. So combined or new company's PE ratio will increase by 15% from the existing. right? That can be easily, we can find it out. So it is estimated that the combined company's annual after tax earnings will increase by 7 million due to synergy benefits. So this is always given, right? Synergy benefit. So synergy benefit is there from combining Vogel company and department A. It looks a bit complicated, right? So there is a lot of calculation that we need to take care of. Anyways, let's get into the thing. First of all, possible reasons why a Vogel company may have switched its strategy to organic growth to one of growing by acquiring companies, right? So what does the answering tips say? So it's a fairly typical question on acquisition with a good mix of calculation and discussion. When asked to perform valuation calculation, follow the cues in the question to decide which valuation method to use, right? So in the given case, we can use PE ratio and then cost of capital and growth rates meant that discounted cash flow and PE methods should be used, right? PE method should be used. Okay. Right. So in number A, the possible reasons why it is switching the strategy, right? So basically the main reason would be switch the strategy from organic growth to the one by acquisition. If it was of the opinion, may have, right? It may have, of course, they normally, I would basically, a person in rational mind would definitely may have switched it to increase the shareholders' wealth, right? Value for shareholders. Okay. Acquiring a company to gain access to new products, markets, technologies, expertise may be quicker and less costly, right? So horizontal acquisition may help Vogel company eliminate key competitors and enable it to take advantage of economies of scale, right? Economies of scale, eliminate competitors, right? And vertical acquisition, what does it do? It basically secures the supply chain. Okay, generic statement, always, right? And then it can maximize its return from its value chain, right? So we can always talk about this thing: quicker and speed, quicker and less costly, right? And then after that, horizontal acquisition and vertical acquisition, right? Horizontal acquisition, what does it do? It reduces the competition. It basically provides us more economies of scale and more power over the market. There is no talk about that, but yeah, it gives you more power. And vertical integration, what does it do? You are basically moving up in the supply chain, right? Like if you are a distributor, you are acquiring the factory, or if you are moving down, right? You're acquiring a retailer or something like that, right? It depends where you are located within the supply chain. Right, next thing is basically organic growth. We have to talk about that as well, right? Organic growth, and why is it like we have to talk negative of it, basically. So it takes long time, right? Because since we are discussing like why it has switched the strategy, right? What could be the reason? So it could be more expensive, long time, expensive, and little competitive advantage can be established due to the time taken, right? Your competitive advantage could be lost over time. Also, organic growth, especially in new area, will need managers to gain knowledge, right? It will need managers to gain knowledge, new knowledge, right? And expertise of an area or function which they do not currently have, are familiar with, right? Furthermore, in a saturated market, there may be little opportunity for organic growth, right? In saturated market, when the market has been fully captured by you or your competitors, then there is not much opportunity for any organic growth, right? So diversification is another way of it, basically. Or unless there is a competitive there is a technological advancement or something, right? For that you will have to do, if you do acquisition, then you can acquire some kind of IP patent, and then you can basically further exploit, right? Not a good word, right? But still. Discuss the possible actions Vogel company could take to reduce the risks that the acquisition of Tory company fails to increase shareholders' value. The possible actions Vogel company could take to reduce the risks, right? To increase shareholders' value. What could it do, right? It could have better integration and all, right? So all these things we have to talk about as well. So reduce the risks, right? So since Vogel company has pursued an aggressive policy of acquisition, it needs to determine whether this has been too aggressive or not, right? Remember they talk about somewhere aggressive policy, right? Aggressive policy. And then they should do a detailed audit kind of thing, right? Detailed assessment. It has to determine whether they have been too aggressive or not. And Vogel company should ensure valuation is based on reasonable input and proper due diligence of the perceived benefit is undertaken prior to the offer being made. Often, it is difficult to get an accurate picture of the target looking from the outside. Vogel company needs to ensure that it has sufficient data and information to enable a thorough and sufficient analysis to be undertaken. Right. The sources of synergy need to be properly assessed to ensure that they are achievable. What actions Vogel company needs to undertake to ensure that their achievement, right? This is especially so for the revenue-based synergies, right? The sources of synergy, it has to be properly assessed, right? So that they are achieved, and what actions needs to undertake to ensure that the achievement is, to ensure that there is the achievement, right? It's achieved. So this is especially so for the revenue-based synergies. So for revenue-based synergies, right? So an assessment of the impact of the acquisition on the risks of the combined company needs to be undertaken to ensure that the acquisition is not considered in isolation but as a part of whole company. So one thing is not creating more risks for the combined company, okay? That's the gist of it, basically. It's like whenever we are making a decision, like not only from an individual perspective right now, but how the company will be in the future, and thinking about it from a combined company's perspective, right? Another thing is how possible actions could reduce, right? The BOD, the role of BOD, they are talking about that, right? Seems like that. To ensure that there are good reasons to undertake, should ensure there is a good reason, right? To ensure good reason to undertake the acquisition, and the acquisition should result in increase in value for shareholders. Always the aim is to maximize shareholders value, right? Research studies into mergers and acquisition have found that often companies are not acquired for shareholders benefit, but for benefit and self-interest of acquiring company's management, right? We can always talk about this. You see, they are just bringing up the same point where, remember, like when the management start to commit and then a lot of money is already spent, so they don't want to say like it's a mistake and all, right? So I think they'll talk about that maybe. The non-executive directors should play a crucial role in ensuring that the acquisitions are made to enhance the value of the shareholders, right? There is NEDs, right? Since this is a listed company, right? We could have written like, since it's an listed company, since Vogel is a listed company, the NED can play a crucial role, right? We can talk about that, like just linking it back, right? Are made to enhance the value for the shareholders. A post-completion audit, right? Post-completion, after the mergers has been or the acquisition has taken place, right? A post-completion audit will help to identify the reasons why so many of the acquisitions have failed to create value, right? And then once these reasons have been identified, strategies need to be put in place to prevent repetition in the future acquisition. So they are just saying, learn from your mistakes, right? Identify your mistakes and then learn from it. So that's the policies and all, or like how BOD can play a role as well, right? So procedures need to be established to ensure that acquisition is not overpaid. Not overpaid. Vogel company should determine the maximum premium it is willing to pay and not to go beyond that figure. Research indicates that often too much is paid, right, to acquire companies, and then the resultant synergy benefits are not sufficient to cover the premium paid. Always, whenever we are doing the thing as well, right, it should not, the resultant the premium paid should not exceed the synergy benefits or the combined synergy that you get, right? The synergy, it should not exceed synergy, okay? The combined companies, the synergy that you get out of two company being joined together premium, because if you go beyond the synergy thing, the company won't have that much profit, right? Then it's not a good thing. You've just overpaid, right? So that often happens, that's what they are saying, right? Often this is the result of the management of the acquiring company wanting to complete the deal at any cost, because not completing the deal may be perceived as damaging to their company's reputation, right? They might think about that. So the acquiring company management may also want to show that the cost related to undertaking due diligence and initial negotiations have not been wasted, right? So they might want to prove their point, right, that the cost, they might want to look good, right, it has not been wasted and all, right? So Vogel management needs to guard against this, right, against this fallacy, right? So that basically is happening. Maybe formal procedures need to be established which allow managers to backstep without losses of personal reputation. This is such a crucial point, this is they always mention this thing in like why acquisitions fail, right? It's always a good thing. If this is allowed, then a lot of overpayment will not happen. Vogel company also needs to ensure proper procedures are in place to integrate staff. So I think we are talking about integration part of things, right? And systems, of the target company effectively, right, it is integrated effectively, and to recognize that integration takes time. Vogel company needs to give target company a large degree of autonomy, just thus make integration less necessary, right? You need to integrate, but why don't you give them autonomy so that the integration is less required, right? However, this may result in reduction in synergy benefit. That also comes with a cost, right? It might reduce the synergy benefit. So Vogel company should have strategy which allow it sufficient flexibility when undertaking integration, so that it is able to respond to changing circumstance or respond to inaccurate information prior to acquisition, right? Inaccurate information prior to acquisition, if we have that, then basically we can save a lot of things, right? Vogel company needs to be mindful that in its own and the acquired company's staff and management need to integrate and ensure a good working relationships, right? The above answers covers more area than what you would need to achieve full marks for the part. Credits will be given for alternative relevant comments, right? Next thing, let's get into the numerical side of things, right? Approach taken, right? That's what we should explain first of all. So the approach taken is the maximum premium payable is, we need to say the maximum premium payable, right? Maximum premium payable is equal to maximum additional benefit created from the acquisition of Tory company, right? Maximum additional benefit created from the acquisition of Tory company with no increase in value for shareholders of Vogel company. Although the shareholders of Vogel company would not approve of the acquisitions if they do not gain from it, right? The additional benefit can be estimated as the sum of cash gain from selling Department C, spinning off Department B, and integrating Department A less the sum of values of Vogel company and Tory company as a separate company. Okay. right? The additional benefit, it is estimated as the sum of cash gained. Okay, right, sum of cash gained from department C and then the spinning of department B, right? Mm, and integrating department A less the value of Vogel company and Tory company as a separate companies, right? Next thing is regarding this estimation as well, right? For C, we will be getting the cash gained is basically how much? We will be getting 100% of the book value. Where is that? Non-current assets, right? Non-current assets is how much? 98.2. But is it that? No, it is 198.2 times 20%, right? 20% times 98.2, and then for current assets we are getting how much? Only 90%, right? So 20% of current assets times 90%, right? Only 90%. Why are we doing 20%? Because within this non-current assets as well, the department C's share is only how much? 20%, right? Remember, they say share of current and non-current assets, right? So that's how we need to segregate that as well, right? After that, what do we need to do? We need to basically subtract the value from it, right? So we need to subtract 3 million from it, yeah, right? And then another thing, this thing as well, remember, it says the funds raised from disposal of UC will be used to pay off Tory companies non-current assets and current liabilities, right? This thing will go away, 20.2. That's why we are subtracting that as well. So the cash gained will be 4.81 million, right? From the selling only, selling and after paying off the debt plus after paying off the non-current liabilities and the what was the other thing? 3 million was closing cost, right? So what else do we need to figure out? So all relevant calculation, maximum premium Vogel company could pay to acquire Tory company, maximum premium, right? So in order to find that, we need to find the value of the new company. That is basically we calculated for C, right? We calculate now for department B into neg day company, right? We are turning that into neg day company, and for that we need to estimate, I think so. So B is we are unbundling, so spinning off it into neg day company, right? Yeah, department being is spin off into new company, neg day right, neg day company. So free cash flow, how much is the free cash flow of neg day company? It's going to be, how much is the B share? It's right over here, pre-tax, pre-tax. So pre-tax current share of PBDIT is basically where is P, profit before tax, PBDIT, it's over here, right? And pre-tax profit, it is 40%. Okay, 40%, right? 40% of 37.4, right? We are not taking the thing at the moment because we have to deduct the interest from it as well, right? We have to deduct the debt part of it, right? So that's why we aren't taking that. And then less, we need to attribute how much, the sales part of it, right? Remember the 10% of the department B's PDID comes from sales made to department C. Now department C is being sold, the sales won't happen, right? So the revenue figure is inflated by 10% higher, by this by whatever sales you are making to department C, right? Which is 10% of the current sales, which is basically 1.49. They have rounded it off to 1.5, right? And then we will also be allowing some tax on it. less, I mean not tax, I mean TAD, right? It will be 10% of the non-current assets. What's our non-current assets? It's not given directly, so we have to find out. 98.2 times 40%. So 98.2 times 40% times 10%, right? That will give us 3.93. And then summing all this thing up, we get our PBT, right? And then we have a tax rate of how much there was for all companies kind of thing, right? 20%. So based on that, we get a free cash flow of 7.62. Right, that's for first year only, right? We have to do it for, where is that? It's over here, free cash flow, right? It'll grow by 20% and then will grow by 20%, right? That is for 1 year only. That is for 0 year currently. We have to forecast it for the upcoming years. So the value of Negde company, the present value of Negde company in year 1. In the first year, it's going to be this amount times 1.2, growing at 20% in the first year, and then we discount it back by our, is that this cost of capital given? Yes, it is given, right? 10% in the question. So we get a value of 8.31 million. And then from year 2 onwards, it's going to be how much? 5.2%, right? So it's going to be 8.31 times, no, it's going to grow by how much? It's going to grow by, and then by 5.2 thereafter, right? Okay, that's going to be 8.31 into 1.0, 8.31 into 1.052. Where did we get that 9.14 from? It has to be 8.31 into 1.2 then. Nope. How did we get that figure? Like, this thing is understandable, the whole formula is understandable, right? We have this perpetuity formula, DVM model, and then just discounting at year 1, that's understandable. 7.62 into 20%, it's going to grow by, in the first year of operation, it's going to grow by 20%, and then it's going to grow by 1.052, right? Mm-mm-mm. 9.14. Right. How did we get that figure? 9.14. 9.14, right? It has to be that. Otherwise, where is it given? Right? Is there any other different growth rate that they have mentioned? It's 20% only. 8.31 times that, and 9.97. That's not it. That's not it. Right? Present value of the cash flow from year 2 onwards. Right? Right. Let me just see. 9.14. Have we missed anything? For Necte company, right? 9.14. Like, it's easy to miss something which is very obvious, right? So you see, why do you think it's not happening is that basically, you see, you are not basically discounting it. Okay, so if you multiply 7.62 times 1.2, right, you will be getting 9.14. So in the first year your cash flow is 9.14, okay, in the first year itself. And that's your let's say FCF, right? And then your discount factor is 1 divided by 1.1, right? And then your present value is 8.31. So in year 2 it is 9.14 on times 1.052 divide by 0.1 minus that. Okay, now understood. You see, you are not discounting it because this figure is for year 2. Okay, it's for year 2. It's for year 2. Don't get confused with this. You see, like doing like this, it's without the tabular format, it's kind of a bit confusing as well, like, right? So yeah, it's just that. Okay, so after that we get how much, and then we just discount it using the same previous rate, right? Because it's at the from year 2 onwards, right? So we just use the previous rate. Remember, whenever there is a perpetuity, we always use the previous discount rate, right? So that is what this is, all these things. So this thing is for first year, this thing is for second year onwards, right? So we add this 2 up and then we subtract the value of debt, right? This is free cash flow only, so we have to subtract the value of debt from it, right? To get, so discounted present value of cash flow, and then present value of cash flow, and then you subtract your debt from it, you get value attributable to shareholders, or the company value, right? To only the shareholders is basically 150.72 million, right? 150.72 million. And then what is Vogel company's value? Vogel company's current value is basically, where is that share price and all, it's given over here, right? Vogel company's value is $3 per share, and then how many shares? It is 190 divided by 0.5, 380, right? 380. So $3, right? So 1140, the current value, right? And then Vogel company's after tax profit is how much? Vogel company's profit after tax is basically, you see, this amount is pre-tax 158.2, right? We have to take 0.8 of it, so tax rate is 20%, right? You see, and then we get a value of that, right? So it's current value and then current profit, right? Why are we doing that? Basically to compute the PE value, okay, to compute the PE value, because we need Vogel company's current PE to calculate the PE of Tory company, right? It's 25% higher than Vogel company's PE, so we get the PE from there. We get PE equals to basically price, that's the whole value, total company's value, divide by your EPS, or let's just say total value divide by your let's just do it this way, it's easier. Price is what? Total value PE equals to price over earnings, right? Earnings. So price into quantity of shares will give you market value of equity, divide by your total earnings plus, that is basically profit after tax, isn't it? Earnings per share times your quantity of share is basically PAT, right? So we are just doing that, we get a PE ratio of 9. So Tory company's PE is basically 1 point, how many times greater than that? It is 1.25 times greater than that, right? So we are getting 11.25. What is the PE after acquisition? It is 1.15 times greater, right? So it's going to be 10.35. So PE of Tory company is greater than the value of Vogel company after acquisition as well, right? So what's going to be Tory company's current valuation then? The current valuation of Tory company is going to be Tory company is going to be 11.25 times what's the current value. We can use the PE method for this as well. Remember, PE equals to price over EPS, right? EPS. So what's the thing over here right now? We know the PE right now, we know the EPS, so we can just calculate the price or the value, right? Value equals to PE is 11.25. What's our EPS or the PAT? Let's just say PAT. PAT is basically 20. Where is that? Where is it gone? It's over here. 23, right? So that's pre-tax. So we have to multiply by 0.8. We get a valuation of this much. Right? We get a valuation of that much. Sorry. So Tory company's current valuation is this much. Right. So value created from the combined company is basically how much? Then it's going to be Vogel company's profit after tax, right? Value created times this thing times 0.5 times 23 million times, what are we doing over here? We are subtracting that for tax, right? Plus this thing, plus your, let's just do it this way. It's easier that way to understand for everyone as well, right? So I'll just do it quickly. Yeah, it's easier that way just to understand. We are multiplying by PE, right? Times your earnings, right? That's what we are doing. PE times earnings, right? So the combined value, it's going to be PE times earnings. We are just adding the earnings of it, right? So okay, so combined companies value will be, remember, on this thing always remember, we have segregated negative companies to different, right? We have unbundled it into a different company, right? So what's the value created from the combined company? It is the earnings it is basically the earnings of what? The combined company should be the current Vogel's profit, and then the department A's profit. Remember, department A is our only company, and then the synergy benefit. Synergy, right? 3 components, only 3, not the department B, right? Not the department B at the moment. Okay, at the moment it's not department B. Okay, so we will need that figure, but yeah, that will come later on. Okay, we will need that to calculate maximum premium, but not right now. So we have to multiply the PE times your earnings. You will get the total valuation, right? So total value that has been created, or total value, right? Total value of the company is going to be how much? It's going to be the current profit of the company, which is this pre-tax profit times 0.8. Then after that, the A company, department A's profit. Department A's profit, right? It's going to be 0.5. Why are we multiplying by 0.5? Because the share of department A's profit is only 50%, right? PBDIT. In the share of profit, it's only 50%. So 50% of 23 million, out of this profit, 50%, right? and that is pre-tax, so we have to again adjust it for 0.8 as well. You see, that's why we are multiplying with 0.8 as well to get the after tax profit plus the synergy benefit. These two companies, I mean one company and another department A, Vogel and department A coming together brings in some synergies as well. Remember where they have told us over here 7 million, so that is added to it times the PE ratio will give us the total value. Now the maximum premium that we should pay for this company is always the combined value minus the value of the original company. Okay, so original company as if they are independent company. Okay, right. So the maximum value that you should pay is Vogel company's value plus the next day company, and then 4.81 you are getting it from where is that, the sale amount, right? Where is that, the sale, you see over here, right? That is also giving you some cash, right? So you're getting all this is also benefit, right? So this is your new valuation, and then your new company's valuation, right? And then your selling amount minus the total company's valuation. Okay, so this is what is Vogel company. Vogel company's current valuation is 1104, and then Tory company's current valuation was 207, right? It is still Tory, right? And then the maximum premium that we should pay is always this much. Okay, the new valuation minus your thing, your independent company's valuation. The maximum premium is this much, 285.80. So assumptions is based on the calculation above, it is estimated that the value created will be 285.80 million, right? That's the value that will be created, right? They have not told us how much premium to pay or anything, right? That's the maximum that we can pay, right? It does not mention like what would happen if something premium is paid, or it's not like that, right? So however, Vogel needs to assess whether the number it has used in calculation and assumptions it has made are reasonable. For example, Nekte company's future cash flow seem to be growing without any additional investments, right? Without any additional investments. So just the tax allowable depreciation is same as the investment needed to maintain, right? So just that much only. Right, it does not talk about any additional investments. And then Vogel company needs to establish whether or not this is reasonable. It also needs to establish how the increase in PE was determined after acquisition, right? After acquisition, how the PE ratio was determined, right? We need to take into account of that as well. Why 15% greater than that, right? Right, perhaps sensitivity analysis would be useful to show the impact of value changes if there is a change in variables, right? Given its poor record in generating value previously, Vogel company needs to pay attention to these figures. You see how they are linking it back, right? So assumption made 2 to 3 points, 3 marks. Approach taken 1 to 2, right? This is always a good strategy, yeah. And what is this? 2 marks for cash gained from sale of department is 1 marks. Free cash flow of Nekte company is 2 marks. Calculation of present value of Nekte company cash flow and value is 2 marks. PE ratio before and after acquisition of Vogel company. Tory company's PE ratio. And value created from combining department A with Vogel company. Maximum premium payable. Right. Okay, interesting question. Very fun, right? Yeah, if you don't understand any part of this thing that I've talked about, do let me know. I'll definitely help you out. The only thing a bit confusing might be this section, that 9.14. Otherwise, everything is smooth. Yeah, just to think it in the mind, it's a bit harder, but yeah, just having this thing helps a lot. Like approach, which approach is you're taking, it helps a lot, right? So yeah, that's pretty much it. Take care. Bye bye.